Hey friends, Loss Ratio here, and welcome to another episode of Loss Ratio Talks About Insurance while he tries to catch a fish. So in previous episodes, I've touched on a few of the benefits of self-inspection as compared to traditional field inspections that have been done for the last 10 decades. But I want to cover one here that I've not yet talked about, and it's all about time. More specifically, turnaround time.
Without time, we don't exist.
So what do I mean by that? Well, it's important to understand that when it comes to property underwriting, carriers have regulatory timelines that they have to abide by. So when we're talking personal lines property underwriting, there is regulation around what is typically referred to as an underwriting period. And what this means is from the time that a carrier binds coverage on a new policy, they have a relatively short window of time available to them to fully underwrite that policy, meaning verification that this property actually meets their underwriting guidelines, that it fits their appetite, that the coverage amount that has been bound is accurate, and all of those things that I just mentioned are why underwriting inspections exist in the first place. So during that underwriting period, shortly after coverage has been bound, a carrier has the ability to make adjustments to the policy. But once the underwriting window has expired, they are no longer able to make any further adjustments until the next annual renewal. So let me share just a very practical example of how this works. Let's say that an agent submits a policy application on a new homeowner's insurance policy, an H03. When the agent filled out the application, let's say they set the coverage A amount for the dwelling at $500,000. They answered a bunch of underwriting questions within the application. Maybe they said, hey, there's no trampoline on the property, the homeowner doesn't have any dogs, and there are no solid fuel heating devices in the home. So no wood stove or pellet stove, fireplace insert, etc. Oh, that was a pike. Just got bit off. So in this hypothetical scenario, we're assuming that the agent has binding authority. The carrier has already assumed the risk of this property. So now the carrier will very often order a field inspection of this property, ultimately to ensure that the coverage that's been bound by the agent is accurate and that nothing has been missed or misrepresented. Now, in most states, the underwriting period is 60 days. There are a few exceptions. There's a handful of states that have a shorter 30-day underwriting period, but generally, most states allow 60 days. And once that 60-day underwriting period has expired, the carrier is not able to make any adjustments to that bound coverage. So let's say in our example that the carrier orders a field inspection. The inspector goes out to the property, and guess what? He finds that the homeowner actually has 2 pit bull dogs on the property. In the application, the agent said there were no dogs. There's a fish. There we go. Not a bad one. Now, was the agent being dishonest? Was the policyholder being dishonest? Answering that question is not the point of this conversation.
We are at the spot at the hotel.
But this type of scenario happens all the time. So let's suppose that the carrier in this example has underwriting guidelines that simply do not accept pit bull dogs. And therefore, either the policy needs to be canceled or perhaps they have a dog liability exclusion that needs to be added. But regardless, a significant policy change needs to be made to account for that exposure. Or consider this. The inspector goes out to the property, completes a full replacement cost valuation on the home, and finds that the actual replacement cost value of the structure is not the $500,000 limit that the agent bound coverage on, but the replacement cost is actually $850,000. Well, now the carrier really needs to adjust that coverage A amount so that they are properly insured to value. So again, a policy adjustment needs to be made. Now, in either of these scenarios, or dozens of other possible policy adjustment scenarios, the carrier needs to make a policy adjustment changing the coverage that was initially bound by the agent so that the coverage is adequate and that proper premium is being collected for the risk present. Or in more extreme cases, which are not terribly rare, they just need to cancel that policy altogether.
Okay. cancel the deal.
Because the risk just does not qualify for coverage under their program. In any of these scenarios, the carrier only has that specified underwriting period to make those changes or to cancel the policy and get off the risk altogether. Once the underwriting period expires, carriers are bound to insurance regulation that says you cannot make any changes and you cannot cancel this policy until the next annual renewal.
Not up in here!
So what does this all mean, and what does it have to do with self-inspection? Well, quite actually a lot, because this is where self-inspection provides a ton of value to insurance carriers. If a carrier can't get their inspection results back from the third-party vendor within the defined underwriting period, they can ultimately get stuck on a risk that they don't want. And this is a huge problem. Now, traditionally, in decades gone by, most third-party inspection vendors rarely had trouble getting an inspection completed in the field and back to their carrier partner within the underwriting period. But as we talked about in the very first episode of this series, as field resources have been stretched thin across the country, the turnaround time of these field inspections has ballooned dramatically. So what does that mean for carriers? Well, it means that ultimately they are getting stuck on way more risk than they ever have before. And while all third-party inspection vendors are to varying degrees doing the absolute best that they can to meet their contractual SLOs, service level objectives, as it relates to this time service issue, this is becoming a bigger and bigger problem. So just to give you a real quick historical frame of reference, generally speaking, most carriers' SLOs that they build into their contracts with inspection firms would require inspections to be completed and returned to the carrier within, say, 30 days. If they receive the inspection within 30 days, in most states that gives them another full 30 days to analyze the inspection report in underwriting and then coordinate with the agent and the insured to make any adjustments that may be necessary. And again, historically speaking, 30 days was generally plenty of time for inspection firms to get these inspections completed. But that has all changed now. With the growing dynamic of very limited field resources, now carriers are seeing more inspections than ever go far beyond that window, and they're getting stuck on those risks. So this is where self-inspection shines.
Here's John.
Most carriers are allowing their policyholders anywhere from a week to 2 weeks to complete and submit their self-inspection. And on average, we see most policyholders completing their self-inspection somewhere between day 3 and day 7. So you can see how this solves the growing problem of turnaround time when it comes to field inspections. Self-inspection just removes all of the friction that inevitably eats up that underwriting period. Inspectors trying to manage their schedules and get out to these very rural properties. Policyholders and inspectors trying to schedule appointments and figure out a time that works for both of them to complete an interior inspection. And quite frankly, carriers dealing with long underwriting queues where even after they've received the inspection results, the inspection sits in a queue for 1, 2, or even 3 weeks before an underwriter even gets to look at it. This is a big pressure facing all property insurance carriers today, and self-inspection is a massive relief valve to that pressure. So I hope that makes sense to you. If you have any questions or comments, please drop them below. I'd love to continue the conversation, and I'll catch you in the next episode.
Insurance coaster has been climbing. Are we almost at the top? Seems the pressure just keeps building. Not sure if we'll ever drop.